So, all right, good. That's good having Andrea in there. It helps if something goes wrong. We have someone out there. All right, so we're up. This feels like this is the first class, but it's not. So anyone want to give me your answer to question 1 so far? It's the first thing you got to do. Define what? What is a portfolio? So what is portfolio? Anyone know off the top of their head? Someone comes to you for an interview. They say, I got $100,000 my uncle just gave me. What do you do?
Collection of assets for a specific purpose.
Specific purpose, and I usually say specific future purpose, but specific future purpose. So yeah, collection of assets, not securities, although for most people it is securities, but sometimes it's assets. I just bought my mom's house and she's going to live in there. So I'm now her landlord. So I now have real estate. I don't like real estate, but I now have real estate. I've got a really good tenant, so I feel pretty good about it. But so I have an asset that's not a security, but most of my assets are securities. All right, and then anybody know the 3 questions you got to ask? Why are you investing? That's that future purpose, right? So if you don't know why you're investing, I really can't help you. What's the biggest word on the why? Horizon. Yeah, you need your money in 1 year, or you need your money in 20 years. I talk about those risk questionnaires. They ask about horizon, risk tolerance, and knowledge, but horizon's the only one we really know makes a difference. So horizon's to me the most important one. The second question, what can you invest in, and what's the big word there? The fancy word? Parsimony or parsimonious. So that's what we're spending all our time now here, talking about fixed income. DC cuts I, and then we'll do bucks when we talk about stocks. So we're definitely going to get into that what very detailed, but we want to know. So we have 3 asset classes. So we have 10 asset classes. At USAA, we had 26 asset classes. You saw Sharp, Dr. Sharp, he had, I think, 13 asset classes. Many of them overlapped with ours, but some of them didn't. So, there's a big debate on that. What do you include? He didn't have real estate in his. He didn't have commodity in his. I have real estate and commodities in ours. So you have to answer that question. And then the last question, how are you going to execute it? And there you worried about what couple of things? Do it yourself or hire someone, and that can be mix and match, right? You don't have to do all yourself or do it all with somebody else. You can do some things yourself and other things with others. And then the other question is what? You can be tactical, you can be passive. What's your strategy? If you have a strategy, are you going to detour from that? Right now, I'm loading up on small cap value and mid cap value because I think they're the cheapest. I win some days and I'll lose some days. Today I was doing pretty well until about 9:30, and then the market's kind of unwound. I don't know what they're doing right now. I haven't looked in a while. So I'm being a little bit tactical. I'm managing my mom's money that I paid her house for. So, I'm hoping she'll do well with that money. So she's trusting me to manage her money. So I'm kind of slowly moving in, hoping for a really big stock sell-off so I can move her more aggressively in the stocks. I'm going kind of dollar cost averaging. So I'm being a little bit tactical there. So, all right, then you get the bonds. Anybody give me DC cuts I without looking at your notes? Sarah, you remember them?
I have it on my notes.
All right, any notes? Hunter, can you remember them?
I think I have the first 3: duration.
Duration? Credit, duration, convexity, credit. What's the 4th one?
Non-U.S. currency, and then it's some
Taxes. The S is one people always forget. Structure and inflation. So we got some news on inflation today. CPI, I don't know how it came out, but I just heard it came out better than expected. The stock market rallied, and then it didn't rally. Now, have you noticed that your paper 1 is completely obsolete right now? Right? If your boss said, have you finished the employment report paper? No, I'll get it to you October 2nd. And she's like, well, it's old news now, isn't it? It was important when you wrote it. So you can see why you really write that paper the day that it happens, usually the morning it happens. So we've gotten a lot of new news it looks like the stock market has been generally down since that report came out. Almost every day, just kind of a slow coming down. And some mornings it starts up, 0.5% or 0.2%, and then it kind of glides down throughout the day. But one of the things we talked about on the employment report was some fear about inflation. So we got good inflation numbers today. You would have think the market would have rallied, and it didn't. I don't know what treasuries are doing today. I haven't looked. You would think good inflation numbers would do what for treasuries? Would they rally or sell off? Do bonds like inflation or do they hate inflation? If you're fixed at 2% for 10 years, is inflation your friend or your enemy? It's your enemy. So hopefully good inflation news should mean treasury yields are down. Hopefully we can't always be sure of that because the market's also thinking about what is the Fed going to do. So there's more things going on. Gold should do what today if inflation news was positive? Go up or down?
I think that inflation is going up.
If inflation's weak today, yeah. So gold would be down today, yeah. So if you have weak inflation, gold should be selling up. I haven't looked to see. I'm just giving you the traditional view of that when you get into an interview. All right. So we'll finish those up today, and then stocks, we'll do bucks. We'll see how far we get. So we were getting through credit. So we talked preferred stocks last time. So we'll start here. All right, the tactical move when you get to credit is you've got to go back to duration and convexity, because now we're getting a bunch of moving parts. It gets a little more complicated. So that's good news, right? Anytime I say it gets complicated, you're like, good. The more complicated, the more they pay me, all right? So it gets a little complicated here. So we've got to have a few things going on. And right now it's actually more complicated because interest rates are so low, but you have recessions and you have recoveries. In a recession, what should credit spreads do in a recession? Should they widen or should they narrow? So you expect a recession next year, credit spreads should widen. It should widen, right? More companies are likely to go insolvent. Credit spreads should widen. But what should the risk-free rate do in a recession? It should fall, right? So you got two moving parts. Spreads going up, the risk-free rate's going down. So if you're expecting a recession, you need to do two things most of the time. You need to move up in quality, and you want to move out in duration, usually. Now, right now, if we go into recession right now, how much can interest rates fall? The 10-year got down to what, 0.5% last year, and it's at 1 point. I haven't looked in a while. What is the 10-year treasury out today? 1.2. I should look it up. I've got two computers here. Why don't I have two of them going at the same time? It's right around 120, 125 or so. It's been trailing down here recently. So you've got that dynamic, but is that always the case? We'll talk about that. But the normal is you have a recession, risk-free rate falls, spreads widen. All right, if you have a recovery, spreads should narrow, right? You shouldn't get paid as much for credit risk because you don't expect as many insolvencies. And so spreads are actually narrow. Remember, the words are narrow and wide. On duration, what do we use? Do we increase duration? Do we shorten duration? Remember the words on that? Shorten and lengthen. And then on spreads, it's narrow and wider. I don't know who picked those words, but those are the words they use. So in a strong economy, you expect risk-free rate to rise and you expect spreads to narrow. So if you're expecting a strong economy next year, you want to move down in quality and move in on duration. You want to shorten duration. All right. Let's see if y'all can do it, because I'm seeing some like, what is he talking about? Looks. I won't call anybody yet because I still don't have your names, but your boss says, all right, boy, the Fed's really going to mess up. We're going to have one massive recession in 2022. And you say, okay, well, in that case, we should, what would you say? Why don't you take it? Move up on quality.
Lengthen duration.
Lengthen duration, all right? And you would say just like that, we want to move up on quality. Expecting a recession, we expect spreads to widen. Sometimes we say gap out, but widen. We expect spreads to widen. We expect interest risk-free rate to fall. So we're going to lengthen duration, move up on quality, all right? I gave you some examples here. So you've got two moving parts. What's the spread? The spread is how much more return you make on the risk-free rate. So the risk-free rate's moving, the spread's moving. So I'll give you some examples here. Sorry, too many moving parts. So before the recession, you bought a triple B bond and it had a spread of 225 basis points. So treasuries were at 5%. So that means it's yielding 5% plus 0.0225, or you bought a bond that's yielding 7.25%. Everybody see that? 5% plus 2.25%. All right. And then you go into recession, the treasury rate falls 250 basis points. So it goes from 5% to 2.5%. Well, that's great for treasuries, but what did your spreads do? The spreads gapped out. They widened from 225 to 600. So that must have been a pretty massive recession. That's like a 2008 kind of recession. Interest rates really fell on the risk-free rate and spreads really gapped out. Can that happen? Well, 2008, maybe. I actually did some numbers that what 2008 did was actually more significant than what happened in the Great Depression when it came to credit. And I actually noticed in 2008, you saw treasuries were making 15 to 30% returns, and corporate bonds for making negative 15 to negative 20% returns. That was one of the biggest. When I did those numbers, it was greater than what we saw in the Great Depression. You saw treasuries rallying, you saw corporates selling off. So what was happening? The risk-free rate was falling and spreads were gapping out. High yield bonds were gapping out of spreads from 500 basis points up to like 2,000 or 20,000. Boy, it went up to 20%, like 20. I mean, it was this massive, massive increase in spreads. So if you look at this, the risk-free rate falls to 2.5%, but spreads gap out to 600. So 2.5% plus 6%, this bond that you bought yielding 725 is now yielding 825. What happens to bonds when your discount rate rises? The bond price falls. So that bond would have lost you money. What bond would you have wanted to own in this scenario? The treasury, right? You don't want that corporate bond. You would have bought if you bought the treasury, you would have made a lot of money. Spreads fell 250 basis points. You're probably up 15, 20% on that bond. On this bond, you're going to be down about 10% or so. Okay. So what's the norm? Well, let's talk the other side. So if you expect strong economic growth, you move into even high yield bonds, you move down in quality and shorten duration. The other thing a lot of students forget when you get the credit, it's also what sectors do you want to be in? So a few years ago, everybody's worried about energy stocks because oil prices fell so much. So everybody's worried about oil companies themselves or the servicing companies or others just having major defaults because oil prices were so low. Here recently, we've been worried about consumer discretionary. Firms like Toys R Us and JCPenney, and how are they doing? They're getting wiped out by Amazon and Walmart, right? So there's been some concern, and Macy's and some really big name. Y'all even heard of Toys R Us? Is that after your time? Yeah, I haven't probably got past that. You probably have never heard of Montgomery Ward though, right? So there's some stores that existed in my time. Radio Shack, is that past your time? Have y'all heard of Radio Shack? All right, so I bought my first computer from Radio Shack, $2,300. And those times dollars, not in today's dollars, have been like 6,000 today's dollars. No hard drive. Had to put a disk in to load DOS. Then I had to type another disk in to load Excel. I had to put like, I think 18 disks in to load Excel. And I've spent more for that computer. And then I bought a laptop just this last week for 1/5 of that price. That does, and you can't even compare the two. Guess what I do with that computer when I was finished with it? I put it in the dumpster. It's like, it was worth, I should have kept it as a museum piece because it was pretty neat. So which sectors you want to be in, you know, so we're seeing certain sectors that are struggling at certain times. So you have to kind of ask which industries are being hurt. So obviously you got travel and leisure right now have been hit pretty hard. So you have to think about those industries. Are they going insolvent? So you have to talk about the sectors you want to be in. There's also what we call event risk. Event risk is when a really strong company gets bought out by management or by some leveraged buyout, and this perfectly fine company becomes really high risk because a bunch of people got together, levered it up, borrowed a lot of money, stole as much value as they could from the company and just let it die on its own. And that's what bondholders, you'll hear bondholders, bond investors talk about their fear of event risk. At USA, this actually hurt us. USA always worried about event risk. And so USA's bond investors, they liked insurance companies, they liked banks because it's really hard to buy out a bank because of the regulators. Well, in 2008, that strategy didn't work because banks and insurers were the ones that were crashing. So USA had one of its worst years ever in the bond market because of avoiding event risk. They picked up an entirely other risk. So this is pretty important. Do we want to lengthen duration? Do we want to move up in quality? And which sectors do we want to be in? So it's a pretty exciting field to be a bond investor. If you're a bond investor, all you buy is treasuries, then what do you care about? You care about duration and convexity. That's about it. There's a gentleman that I highly recommend going to his website. It's called Hoisington Asset Management. A guy named Lacey Hunt. Really sharp guy. He publishes a quarterly newsletter that I highly recommend you read. His company buys only treasuries, nothing else. And all he does is he bets between, all he bets on is duration. Either buys T-bills, which is really short duration, or he buys 30-year treasuries. And he's been the best bond investor the last several years because he's been heavy and long treasuries that have done extremely well. But his only thing he worries about is duration and convexity because he doesn't take any credit risk at all. And he's probably the only person that does that. Doesn't sound very exciting, right? Because you don't have, all you have of the DC cut size is DC. You don't have anything else. And that's all he does. And he's pretty rare. But most investors, they have to make the credit decision. They've got to make, we're going to buy triple A's or triple B's or double B's. And how long is our duration going to be? They've got to make all of those decisions. And then what sectors do you want to be in? So you've got a lot of decisions to make if you're a bond investor. So here's the scenarios. Spreads can widen, spreads can narrow, the risk-free rate can rise, the risk-free can fall. So the two blue ones are the most normal ones. So when you're writing the exam 2 question, you'll probably be in the blue area. Although again, we're at such low risk-free rates right now, it's kind of an unusual period. But the risk rate falls. When does the risk-free rate fall? Usually in a recession. Everybody knows the Fed's going to be cutting rates, so the risk-free rate falls. Spreads widen. When your spreads widen, when you're expecting a recession. So those two make sense together, right? Spreads widen because the recession is coming, risk-free rate falls. Prices can rise or fall depending on how much the risk-free rate falls versus how much the spreads widen. Treasuries will do well there. AAA bonds will do well there. Double B, single B bonds are probably going to do horribly in that scenario. And they can fall a lot. Junk bonds can fall 25, 30, 40%, just like stocks, because they're pretty dangerous in a recession. The other one is risk-free rate rises, usually in a strong economy, right? Economy's taking off, interest rates rise, the Fed's trying to keep things from getting overheated, so they're raising rates. And spreads narrow, why? Because you have a strong economy, weaker companies that might have gone under, they get saved by the strong economy. Again, prices will rise or fall depending on what moves more, how much the risk-free rate moves versus how much spreads narrow. So treasuries and AAA bonds are probably going to do badly in that scenario. Double B, single B bonds will do extremely well. And that's, like I said, in 2008, junk bonds were up 70% in 2008. They can move a lot. And then the other ones, spreads widen and rates rise. What are you looking there? That's got to be inflation. That's the 1970s. Y'all don't remember 1970s. I was in middle school and high school in the 1970s. It was high inflation. That's all anybody was talking about. Poor Jimmy Carter, he cut speed limits down to 55. In the winter, he was talking about people wearing more sweaters, and people were just making fun of him of what he's trying to do. Energy prices were so high. He didn't have, we blame him for a lot of stuff that was probably the Fed's fault. The Fed kind of let inflation get out of hand, but he was kind of stuck with this high inflation. It's hard to do much when you have high inflation, because you really have to fix that problem, and there's no easy way to fix that problem. Anybody know who's the savior that fixed that problem? You remember that Fed chairman, famous one, still alive? Starts with a V. Does that help? Got heard of Volcker? Does that sound familiar? So what did he do? He came in, he gave Ronald Reagan 2 recessions right together, 81, 82. But that was okay. Why? Because the election wasn't until 84. So he got reelected, but 2 recessions right together. Why did he do that? He had to get inflation down from double digits back down to normal. So that's a pretty bad scenario. There are people out there that are predicting this is what we have ahead of us in the US, because there's so much money printing by the Fed. With all that money printing by the Fed, we've got these big companies making all this money. We're going to see bad economies with high interest rates. You have to have inflation for that to work. The opposite of that is what happened here. Spreads narrowed and interest rates fell. What was that? That was the early 80s when inflation came back down. Inflation came down, the economy took off, interest rates fell. That's like you cannot go wrong in that environment. You're making money. If you don't make money in that environment, you're doing something wrong. You should just be able to throw darts and make money. Everything was doing great in that environment. Obviously, stocks are doing really well, but bonds were doing well as well. You bought a bond yielding 15% and interest rates fall to 5%, that bond is going to be up a lot, 30% or more. So it was a great time to be an investor. What about the 70s? Was that a good time to be an investor? We had one period there where you made no money at all in the stock market if you adjusted for inflation. You actually lost money in stocks. It was a pretty horrible period of time. So which of these, what's the chances that we're going to get this one in the bottom right going forward? That one's impossible, isn't it? Can inflation really come down dramatically? What is inflation been? 1.5%, 2%. So that one's pretty unlikely. I know we've had high inflation the last few months, but I mean, bigger picture, years and years of high inflation. So you can kick that one out. I don't think this one down here is, that's the kind of the challenging one. We could go into recession, the risk-free rate falling, how much more can it fall? So it could fall, but how material is that going to be? So that one's a little tricky. This one, I think a lot of people are worried about this one and these two, both of them. So I think this is the one people are most worried about, the one in the top left. But think in terms, this is a good chart to keep in mind, even though right now we're in a very unusual period in time. So you think in those terms, where do you want to position the portfolio? You've got 2 things going on, spreads and risk-free rate. All right, questions on that? That's a pretty important concept right there. If y'all got a question like this in an interview, could you handle it? I have students that I know understand it, and yet when they verbalize it, it just sounds terrible. So you got to somehow get in the practice of verbalizing these things, getting used to the word widen and narrow and lengthen and shorten, get used to the term and put it in the right place, right? So start sounding like an investment person. That's one of the reasons these student organizations help you, because you can kind of practice the lingo. All right. So I'm not gonna go through that. Y'all can read that in the notes. It just does an example. It uses that formula we did, minus duration times the change in yield, and just looks to see, are you winning or losing in a different environment? So I gave you a couple of those, so I won't go through that. All right. So that's credit. Any questions on credit? What kind of career do you have in credit? Well, you're a bond analyst and you look at corporate bonds. Pretty straightforward. It's really not radically different than being a stock analyst. I knew one guy at USA, he actually switched between being a stock analyst and a bond analyst, and it wasn't all that difficult for him. It's very, very similar type of analysis. I mean, there's big differences, obviously, because you're so focused on spreads, but the analysis you do of a stock, looking at all that stuff we did in 3013, right? Liquidity, solvency, turnover, margin, all that stuff we learned in 3013. It's the same whether it's a stock or a bond. You're trying to figure out, is this firm going to be around in 5 years? So it's very similar. It's just that on the fixed income side, you're really focused on that credit spread. Are you getting paid enough over treasuries to compensate you for the risk of this bond? All right, so now we get to the U. So DC cuts the U. This is, do we do something to our portfolio by buying bonds outside of the United States? That sounds really good, right? You get good diversification. The problem with this and why this particular one is not a normal asset class for most investors is that bonds are fairly stable asset class. They don't move around a whole lot. But when you go overseas, you're picking up currencies, and currencies are very volatile. And so if you buy UK bonds or you buy Euro bonds, or you buy bonds from China or for India or wherever you buy bonds, or Brazil, you're buying the bond, but you're also picking up currency risk. And what happens when you do that is you don't even notice the bonds. All you notice is the currencies. The currencies just make the bond. Currencies are very, very volatile. USA, when I was there, they were thinking about starting a non-US bond fund, and the head of the department, Cliff, says, I don't want to do it. We're going to have our customers are going to see European bonds and think, oh, that's low risk, and they're going to stick their money into it, and they're going to see these huge 5 and 10% variations. They're going to say, wow, I thought this was a safe investment. And they just didn't realize, boy, you're taking a lot of currency risk. They might say, well, why don't I just buy Japanese bonds, but then I'll hedge out all the currency risk. Well, what you're going to discover when you do that is you're just buying US bonds. You're not getting anything out of it. You're not going to notice that. All right. A friend of mine, fairly wealthy guy here in town, he's from India. And so he goes, you know, I can buy a bank CD in India for 15%, and I can only get one for 2% in the US. Why wouldn't I go to India and invest and get 15%? What do you think that is? What's the big key for that? What is the bond market telling you? And that sounds good, right? Wouldn't you rather make 15% than 2%? Now, the bond market should be telling you that you should be indifferent in those two bonds, unless there's some mispricing. How can you be indifferent between 15% and 2%? What do you think is the one? It's on this page. What's the one big thing that you would have to get right?
The country's inflation.
Inflation. Very good, Brian. Yeah, inflation. What is the market telling you? They're expecting much higher inflation in India. And if India's inflation is exactly what the bond market expects, then you would buy the bond in India, making 15%. It would mature several years later. You convert it back to US dollars, and guess what would happen? It would revert back, so you end up making the 2% you would have made in US, because you'll lose so much in the currency because their inflation was higher. How do you win on that scenario? You buy the bond in India at 15%, and India's inflation is much lower than expected, then you win. But what's the chance that you're going to get that right? You got a PhD in economics, you got a 52% chance of getting that right. Right? They're not even all that good at it. So it's pretty tough. So at USA, we did not have this as an asset class. Most people that do these bonds, it's usually an alternative asset class. So it's pretty rare. You can go out to Vanguard and Fidelity and T. Rowe Price and see if they have a non-US bond mutual fund, and just see how many have. You're going to find it's pretty rare. There's not that many of them out there. Now, when we get to stocks, it's very common to invest overseas in stocks. But why is that? Well, stocks are very volatile. Currencies are volatile. They offset each other. You don't notice it so much. They kind of hedge each other out. But with bonds, when you buy bonds, you're essentially making a bet on the relative inflation of two countries. And you're making a bet that the inflation embedded in that bond is wrong. The market's either, right now inflation is pretty high in a few countries. If you think that's wrong and it's going to be fixed, they're going to do something, like Turkey or Brazil or someplace. If you're right, you've got a better forecast of inflation than they have, then yeah, you can win. You can win on that. This does tell you something. If you're going to be a bond investor that does global bonds, not just US bonds, you're most likely going to have a master's or a PhD in econometrics. You're going to be an economist, because those bonds, you have to know about deficits and inflation expectations. What are the central banks doing? Those type of things. You'd have to be an expert on those. When I was at USA, we had a bond portfolio that was overseas, because we had a small operations overseas, and the bond guys came to me and said, we don't want to manage those bonds anymore, because those markets are not open when those markets are open when we're asleep, and we don't want to mess with it. And so I said, okay, I'll take care of it. So I went and found a bond manager in the UK. He was an economist. He had a PhD in economics, and I just gave him the money. It was only like $70 million. It wasn't all that much. but it was enough, and that's why they hated it, right? They're managing 30, $40 billion and they got to spend all this time on 70 million bucks. And they're like, we want to, it was pretty funny when we made the presentation. I still remember this. We had the CEO who was just, man, he didn't approve anything. And I made the presentation to hire this manager. And at the end of it, he goes, does anyone know what Ron's talking about? And I go, no. Does anyone have any reason not to approve it? They said no, and they approved it. I was like, okay, I caught them on a good day, but for some reason they approved that and we hired that manager overseas. But you can see their problem. I mean, it's that 70 million bucks created all this extra work. And they didn't want to have to mess with that. It was just too much to have to deal with. So how do you talk about inflation? Inflation is actually something you should become somewhat an expert in. In my 3013 class, I gave them an article on inflation that I hope they kept because it was a really good article. Inflation, we make it like it's this obvious number, like the number that came out today, but there's a lot of debate about the CPI, and there's other ways to measure it, right? The PPI, you have the adjuster that the Fed uses. What's the right number? We really don't know. It's hard to say. We know if coffee prices go up, then maybe people buy more tea, or if banana prices go up, you buy more apples. People substitute things. There's things that people do. My computer that I bought 30 years ago for 2,500 bucks, today it costs 500. Does that mean inflation is negative? Well, what's the problem with that comparison? And you compare that $2,500 computer to the 500 one today. So you've got the quality changes, which for computers is massive. I mean, I don't even know how you do the adjustment on that. So inflation is actually a pretty difficult thing to do. The economists came up with something called the Big Mac Index. You might look that up. They created it. I think when they created it, it was kind of a joke. They were just going to do it in an article. But their argument was the Big Mac is the one product that's sold essentially everywhere in the world. And it's very similar. And so let's just see how much does a Big Mac cost in UK versus South Africa versus the United States versus Brazil. It should all cost the same, right? You shouldn't be able to drive into Canada and buy 1 million Big Macs and drive back to the United States and sell them, buy them in Canadian dollars in UK and Canada, drive the million Big Macs back to US and sell them in US dollars and make money. All right, I doubt you'd be able to do that anyway. So who's going to buy a Big Mac out of the back of your car trunk? But essentially, they should be the same price, and they're not. If you look at the Big Mac Index, someone might want to look it up. You look at the Big Mac Index; it's pretty radical. In fact, let me see it. So let's see if we can go find it out there. Sorry, I've got two PCs and I keep hitting the wrong keyboard. I do that at home, and it's pretty frustrating. Did y'all ever heard of the Big Mac Index? They use that in your classes. It comes from the economists. They created it. And interesting thing is, even though it might have been a joke, it's now, people use it now. So why the Big Mac? I think there's some pretty stark differences between in different countries. See, this computer keeps freezing everything I do. You got labor differences. Where are you sourcing, lettuce and all that kind of stuff? There can be some difference that's pretty tough. And one thing I think about Big Mac, it's not like you're buying gold or buying a PC, something that is easy to take with you. You've got something that that is perishable. So Venezuela's up there on the top. They don't have it in dollars. I like it better when they do it in dollars. Let's see if we can find. So there's the US dollar. Who's up there at the top? Usually it's Switzerland or somebody. I don't know who they are. Yeah, at the bottom, I guess it's Switzerland. So I don't know who these, Russia, Lebanese, South Africa. So these are all the cheap currencies. And here's all the expensive currency. Now, it used to be US was far on the left. And for some reason, they come back up to the top. So U.S. currency has been doing pretty well. So that means you could fly to Venezuela, buy all the Big Macs you could buy, fly them back to the United States, sell them here, and you could make a lot of money. All right, assuming you could get that transaction to work. Maybe you own a McDonald's, so you fly down. You could probably justify I don't know how you keep them warm or whatever. It's kind of grotesque. I haven't eaten a Big Mac in probably 40 years. I think they're the worst thing ever. Y'all eat those things?
It's a little max, or like every year the patties have gotten
Getting smaller and
smaller.
Yeah, I just thought it was a terrible hamburger, but I mean, that's the thing. Why is Venezuela currency so cheap? Well, there's obviously high inflation in that country, and that makes a lot of sense. Why is the Lebanese so undervalued and these other ones? So I mean, overvalued, undervalued. Well, gee, I wish they would do it in dollars. They changed the way they represent it. So I hate currencies. It's my least favorite thing. So don't trust me on that. All right. But anyway, Big Mac Index is a way of thinking about it. Could you do something else? What other product do you know that's sold all over the world and it's very similar everywhere in the world?
Yeah.
Maybe cell phones. Who knows? There's a lot of different brands, and who knows? It's hard to say. I always thought of Coca-Cola, maybe. Starbucks coffee, maybe. But the Big Mac Index has stuck around, and they've gotten serious about it. Now, what else could you do besides the Big Mac Index? Well, you've got the purchasing. Oh, I'm sorry, Andrea, I didn't share screen. Boy, it's hard for me to do.
That's okay. I could still see it in the back.
Oh, that's right. You're in like doubling up here. Wow, how cool. So what did y'all learn in your classes? Purchasing power parity. I remember that, PPP. So what does purchasing power parity do? It looks at a basket of goods and tries to see, is everything priced correctly or not? But again, I hate currencies. I may have told you all this story, I can't remember, but I bought a sweater in Germany. I thought I was buying it for 80 bucks and it was 500 bucks because I divided when I was supposed to multiply. I could tell that lady was smiling more than she should have been smiling. It was cold. We were at New Swanswick in the castle. So it was cold, but it wasn't that cold. All right. So you can find these. The Bloomberg machines have a PPP function that you can go out and look at and does pretty cool stuff. So what's the problem with the PPP? Well, if you say, wow, this currency is cheap, this currency is expensive, so you buy the cheap one and you short the expensive one, you can be waiting for 15, 20 years for those to come back together. So it's not something that you can, there's been a lot of papers written, can you make money just by using PPP as you're trading, and you won't make much money. It doesn't work. So currencies like the Swiss currency, the franc or Swiss dollar, it's almost always expensive. It's almost one of the best currencies out there. Why is that? There's just certain things that they do that the people like their currency. It's a nice, safe place to go. So there's more going on here than just these arbitrage transactions. All right, so yeah, share screen. I need to do that for the video too, right? So, all right. There's a lot more we can do this. This is not an economics class, and I hate currency, so we're going to jump on to the next one. Okay, T for taxes, not Texas. T for taxes. Municipal bonds. You've probably heard of municipal bonds. This can be cities, counties, states. It can be hospital districts. There's a bunch of them. They have special tax-free status at the U.S. level, and states that have state income taxes, like Florida or New York. If you're municipal in that state, you also get state income tax protection. So if you go to like Vanguard or Fidelity, not only will they have a municipal bond fund, but they'll have a Florida municipal bond fund or a New York municipal bond fund or a California municipal bond fund, because you can't just buy munis and get tax exemption in those states. You have to be in those states. So they're tax-free. You don't pay any tax on them unless you sell them for a gain. There is capital gains tax, but the interest, the income is not taxable. So it's tax-free. I had a debate with one of the professors here. I'm using a formula that they use in practice. She uses a formula that's logical. I don't give you the logical one. I give you one in practice because that's what you're going to see. She's like, why would you do that? That's backwards. And I'm like, yeah, it is backwards. But that's the way to do it. So this is how we do this. You would think what you would do is take the yield on a taxable bond and take the yield on a tax exempt bond and reduce the taxable bond yield for taxes. Right? If your tax rate's 30%, then you take 70% of the taxable bond and compare it to 100% of the tax-free. That'd be the most logical thing to do, wouldn't it? But that's not what we do. We take the tax exempt bond and we divide it by one marginal tax rate and we gross it up to be comparable. Now her argument is, what, that rate doesn't exist. So yeah, it doesn't exist, but this is how we do it. And I can't tell you why this is the way we do it, but this is the way we do it. We take the tax exempt yield, we divide it by one minus the marginal tax rate, we gross it up so we can compare it to that taxable yield. All right. If you do it her way, it still works. You get the same answer. It's just whether you multiply or divide. But her argument is you can't actually get that yield. But probably the reason this formula is like this is because it was probably developed by the tax exempt bond managers. And obviously they want to increase their yield number to make it look better. So I don't have, on this page, I don't have the current yields. So let me get the current yields. If I can hit the right keyboard. So the tax exempt fund right now has a yield. Let's see how good this, oh, well, I hit the wrong button. I got the Austrian traded index. That's not what I wanted. I'm using a bond fund I actually use, so I'm always, it's good to go and look, see what's going. All right, its current yield is 2.54%. So how's it done since I did these notes? I did these notes, it was 2.82. Now its yield is 2.54. So is it having a good year or a bad year? Its yield is down. So what is its price done? Its price is up, all right? So this bond has appreciated in price. So it's now at 254. I can't actually do that, so we'll. Come on, Bill Gates, you can do it. Okay, so the US ATX today is 2.54%. And let me do a taxable bond fund. Now, what do you think I need to be holding constant here? What do we talk about with the box with credit? There's two things I need to keep constant. I can't just pick a tax exempt bond and taxable bond fund unless what? They have the same what? The same duration and the same credit quality, right? I can't take a high quality municipal bond fund and a low quality corporate bond fund. They got to be same quality and same duration, right? I can't be short term and long term. So I'm going to have two bond funds that have the same general quality and duration. Oops. So this is the USA intermediate term US IBS. Whoops, what did I say up here? I didn't have a num block, so 254, right? I hate it when the num block is off. So it's yielding 2.53%. Boy, that is amazing, isn't it? Shouldn't the tax exempt bond have a much lower yield? It's tax free. And this has been true for some years now. I've just never seen it quite. I mean, this is the time. Right now, it doesn't matter what your tax rate is. You're almost indifferent in these two bonds if your tax rate is 0. So this tells us that there's almost no scenario where you shouldn't be buying the tax exempt bond fund. Even if your tax rate's only 10%, you're better off buying the tax exempt because there's almost, in fact, the amazing thing is the tax exempt is actually higher than the taxable, 1 basis point. That is really unusual. I've never, for my entire career, because I was responsible for helping the bond people know, does that mean the class is over? Helping the bond people know whether they should be in taxable or tax exempt. Don and I would go back and forth emails. And for that entire period, I mean, you have to, y'all see numbers and they don't seem bizarre to you. I look at them and I'm like, wow, that's the craziest thing. So for my entire career, tax exempt bond yields were always lower than 10-year treasury yields. So the 10-year treasury would be like 3.5%, tax exempt would be like 2.5%. What are they today? Is the 10-year treasury higher or lower than 2.54%? Yeah, much lower. So you're in a strange world. If I'd woken up during my career and saw that, I would say, okay, someone at Yahoo Finance typed the wrong number. There's a typo in Bloomberg. There's no way tax exempt bonds can be paying 254 and the 10-year treasury 125. That's just mathematically impossible. But for my entire career, the tax exempts are like 15% below the 10-year treasury. And now they're probably double the 10-year treasury. So we're in a really strange period. Why is it? Well, maybe it's because municipal bonds are really dangerous right now. However, if you look historically, municipal bonds have actually been slightly less dangerous than comparable corporates with the same credit quality. So I know it just seems crazy right now. So what does that mean? Well, which one are we going to gross up? The tax exempt, right? And how do we gross it up? Let's say your tax rate, and which tax rate is it? Your marginal or your effective? You always use a marginal tax rate because it's a marginal decision. So it's your tax on your next dollar. Let's say your tax rate is, I don't know, 30%. So the tax equivalent yield is going to equal what? 0.0254 divided by 1 minus 0.3. That will equal, it's kind of nice having two computers. I'll check my work. What did y'all get? I hear any clicking going on. 3.63%. You're going to take that 3.6% and what do you compare it to? 253. And which is higher? 363. It's pretty easy. So you see your uncle this Thanksgiving and you know he's really wealthy. So you know his tax rate's probably 20-30%. You say, hey, uncle, what are you investing in? Oh, I'm in the US IBS. You say, well, why aren't you buying the US ATX? Right? You can now say, what would he say to you? Why isn't he buying the US ATX? Not been paying attention, right? You say, come on, uncle. I thought you were smart in this kind of stuff. And don't say it like that. You want your inheritance, but it's that straightforward. And we're in an extremely unusual period of time right now. Really, really unusual. Now, this is like, I mean, we're in an unusual period of time because we were higher than 10-year treasuries. Now we're in a period of time where we're actually higher than the taxable bonds. It's just, I can't wait to get back to Victory Capital and ask those guys. It's like, why in the world is this going on? They've got some really good municipal bond portfolio managers there. They've got some really good corporate bond managers there. I wonder if they even know which these two things are going on because they're two different worlds. They don't always talk to each other. All right. So I have students that do this on the exam. They also tax adjust the taxable bond. That makes no sense at all. Right? It's already taxable, so you don't want to tax adjust it up. You only adjust the US ATX, but always have at least a third or fourth of the class. They do that calculation for both bonds and then they compare, and that makes no sense. I mean, there's no reason to do that. You're taking the tax exempt one, you're trying to say, well, let's gross it up. What would its rate be to compare to the US IBS before tax and compare those two? So right now, tax exempt bonds are paying a tremendous extra return. And there's no reason, same duration, same credit quality. There's really no explanation for what's going on right now. I should go back and get historical numbers and see how many times this has happened historically. I bet it's incredibly rare. We may be looking at, who knows? This might be the only day in the entire history of the last 10,000 years. Who knows how rare this is? It's pretty unusual. All right. So it is straightforward on the exam. I have to give you the same quality and same duration, and you got to decide between the two. You'll see that when we do the practice problems. So Yes, recession or not recession? I say recession, okay, now we know risk-free rate's gonna fall, we wanna move up in quality, we wanna move out in duration. Oh, I've got a high quality tax exempt bond and a high quality corporate bond, they're both longer duration. Well, they do well, they're high quality and they're longer duration, but I gotta pick between the two. So which would you pick if that was your case here? You pick US ATX or US IBS? Which do you pick now? If y'all can't answer that, then I just wasted 20 minutes. That was, which one do you go with? ATX, US ATX. All right. So if I give you that on exam, they both fit high quality, longer duration. That's good. Now we got to pick between those two. And that happens a lot. That's what we did at USAA. We picked between municipals and taxable corporates. We decided which we're going to go in based on our marginal tax rate. I had to go to the tax department and figure out our marginal tax rate. I'd send that over to Donna. She would do essentially this calculation. It wasn't all that difficult to do. And then she would make a decision how she was going to invest. Now, USA was a little unusual. You had the reciprocal and you had the equity companies. The reciprocal was essentially tax-free. So USA is an unusual organization. They're essentially tax-free. So there was no reason to buy municipals in the reciprocal because it didn't pay taxes anyway. So it was really the subsidiaries that were looking at buying these bonds. All right, so there's taxable versus non-taxable. All right, now we can spend the next 7 months on structure. This is essentially one half of that Fabozzi book. This is massive, but we don't have time to do that. I'm only introducing it because it is pretty important in finance because of what finance has done, because of financial engineering and all of this tranches that they've been doing. It's gotten pretty complex. But as I think I mentioned earlier class, your entire career could be one of these letters. Your entire career could be CMBS or CDOs or CLOs or PACs. Well, you probably wouldn't just do PACs, but CLOs, CDOs. Anybody know what IOs and POs are? Not initial, oh, that's IPO, but IO and PO, what are those? Any guesses? We're talking about mortgage-backed securities. What's the I in the P of mortgage-backed securities? The I is interest. The P is principal. So any guesses on the O? So interest only or principal only? These are, I don't know who is having a boring day and they said, well, I'm gonna create something crazy. That they created something crazy. They took these mortgage-backed securities, put them all in the trust, and they say, hey, this particular one is only going to give you interest payments. So you know when you pay your mortgage, part of it's interest, part of it's principal. So this one says, hey, when all that cash comes in from all the mortgages, we're going to strip off just the interest payments. We're going to send these to these IO people. The other one's just going to strip off all the principal payments and give them to the PO people. This one, like, my brain hurts thinking through the scenarios. What does that mean? And boy, it's really tough. I shouldn't do this in front of you because it's like with currencies, I can't get it right. But interest rates fall, so what do people do? They prepay their mortgage. What is that going to do to your interest payments? You're going to lose a lot of interest, aren't you? What's it going to do to your principal payments? You get the same principal payments, you're going to get them a lot faster. So what is the duration of an IO and a PO? I'll leave that to you because I'm not going to try it in front of you. But these are very complicated securities. This is when you can start getting like negative duration type securities. Very complicated. Why would they do that? Well, the reason they do the IO and a PO is for the PACs. The PACs are the people who say, you know, I like mortgage-backed securities, but I don't want to get crushed if interest rates fall and get all these prepayments. And they say, well, you know what we'll do? We'll create these special classes of IOs and POs, and they'll take that first wave of refinancing, and we'll protect you. You'll get a lower yield, and your lower yield, we're going to give that to them. So they're getting paid a lot for that high risk, but if interest rates really fall, they're going to get crushed, and you'll be protected. So the PAC, you know, if the coupon on the mortgages is like 6%, the PACs might make 5.2%, and they're going to take that difference and give it to IOs and POs. And there's a lot more of those than just PACs. There's a bunch of them out there. If you take the CFA exam, part 2 of the exam goes through a lot of these, but there are entire chapters in Fibonacci that just do this. For our purposes, it's just this idea of tranches or tranches. I always say tranches. I don't speak French, so I don't know how to pronounce any French speakers here. How do you say that word? Yeah, how do you say that word?
Which one?
This right here. Tranches. That's the way I say
I
it.
mean, it's kind of the same, just like try to pronounce the R of the G.
Yeah, it may not even work in French, but I mean, its origin is from French. I say tranches. People say tranches. What they're doing is they're taking a bunch of securities that have cash flows, and they're saying, you know what? Instead of just passing these cash flows on, we're going to put them in these different buckets. And so some people get these, and some will get these. If you've heard of zero coupon treasuries, you've heard of those. Well, the Treasury doesn't issue zero coupon notes. How do you create a zero coupon? Well, you buy a bunch of treasuries, you tranche out, you divide up all the cash flows, and one of the buckets you create is only the principal at the very end. And that becomes a zero coupon treasury. So finance has gotten a little too sophisticated here. It's beyond the scope of this class, but if you take the fixed income class that they have, which I highly recommend, you'll probably get into some of these. It gets quite complex. They are more complex bonds, and a lot of times they're less liquid than other bonds. And because of that, you might get a liquidity premium, get paid a little extra because of the complexity. And so that's nice to get a little bit of extra. Maybe 5 basis points, 10 basis points, who knows? It may not be a lot, but you get paid some. These things were so dangerous in 2008. They were pretty scary. I almost got it USAA in one of these, and the fixed income guys said, "You're stupid if you ever do that." And I trusted them, so I didn't do it. All right, the last one we'll do, and we'll start next class, we'll do inflation. We've talked a little bit about inflation before, but we do not now have a brand new security called TIPS, the Treasury Inflation Linked Bond. And I'll give you a little bit of history of that. It's only been around since 2003. There have been these bonds in other countries, but in the US, just since 2003. So we'll start there. Any questions on anything? Everybody's good? Remember where you're sitting. If you change your seat, just let me know. I'm going to try to learn your names and faces. I've learned your names. I just haven't learned your faces yet. So September 16th, we're going to finish up DC Cuts I. So what do we have so far? Someone walks in and says, I got 500,000 bucks. What should I do? So you can say, okay, well, you want to build a portfolio. A portfolio is a collection of assets for some future purpose. You're asking 3 questions. Why are you investing? Really focus on horizon, though some people look at risk tolerance and at knowledge. What can you invest in? Can you invest in commodities? Can you invest in real estate? Most people say, no, I can just buy stocks and bonds. And say, okay, that's kind of boring, but okay. But we want to be parsimonious, so we'll see if we can explain risk. We saw with William Sharp, he did not have assets other than securities. He only had securities. Now, why do you think he only had securities? Any guess on that? What was his big hindrance between real estate and commodities? Any guesses? What did he not have that we have in 19? Well, the internet, but data. He didn't have data. So if you don't have data, real estate is a tough one. We're going to talk about real estate and getting data on real estate. Even today, getting data on real estate is very unreliable. And then the last one, well, okay, now we know why you're investing. We know what you can invest in. Now we just got to do it. You're going to do it yourself. You want to hire somebody. How tactical do you want to be? So we've gone through the asset classes, cash and bonds. Remember, you distinguish between cash and bonds. Cash has a lot of what risk and not much of the other risk. What does cash have a lot of risk of? Do you remember the 2 risk? Starts with an R. Does that help you any? Reinvestment risk. Cash has a lot of reinvestment risk, but very low price risk or interest rate risk. So cash and bonds are identical, except for the timing. Cash has low reinvestment risk, but really, high reinvestment risk, but very low or non-existent price risk. Bonds have varying degrees of reinvestment and price risk depending on the duration of the bond. And then we got into bonds. Anybody off the top of your head can give me DC Cuts I without looking at your notes? Takers for
convexity credit, US versus non-US tax structure.
Inflation, good. He's got it. All right. So you can talk each one of those. I texted my buddy at Victory Capital and I go, what are you guys doing over there? You know that your municipal bond fund and your taxable bond fund have the exact same yield. It's like, I've never seen that before. He says, yeah, I don't know what they're doing. That seems pretty crazy. So maybe he'll get back to me. Maybe he'll check and let me know what they say. He doesn't manage either one of those funds, so he couldn't tell me what's going on with his funds. They were doing some structured debt in the taxable fund. He thought that might have had some impact, but we'll see. We'll see what he says. That is very unusual. I mentioned it, my entire career at USAA, municipal bond yields were at 85% of the 10-year treasury that whole time. So if the 10-year treasury was at 4%, municipal bond yields would be 15% below that, whatever that is. Today, they're what, double the 10-year treasuries. So yeah, we're in strange times. All right, so today what we'll do, we'll finish up the inflation real quickly, and then we'll get into stocks. So inflation, as we talked last time, bonds, most bonds are nominal bonds. That means they pay a fixed rate no matter what happens with inflation. So if you buy a 10-year treasury yielding 1.3%, you're going to make 1.3% for 10 years, no matter what inflation does. So if inflation's 2% over that time and you got 1.3%, then you actually lost real value. You had a positive return nominal. You know the difference between nominal and real? Nominal means, it's just whatever the number is. Real means you take it and you adjust inflation out of it. It's hilarious. I've got a former student. He's changing the world. He's in education reform. A guy named Corey. You should all look him up. He's going to be Treasury Secretary. Education Secretary one of these days. He is very well known. He's very much hated by certain unions, but people talk about how we're defunding public education, and he points out that public education spending is up 180% in real terms since 1980. And every time he does that, someone comes on and says, you idiot, when you adjust for inflation, that's not all that good. Well, what does real terms mean? You adjust it for inflation. And so I said, Corey, why don't you just say in real terms, parentheses, adjusted for inflation is 180. And so he did that, and guess what he got? You idiot, if you don't adjust for inflation, it's like, there's no way. So now what's happening, anytime he writes that, all of his friends come on and talk about what an idiot is for not adjusting for inflation. It's now become this big joke. But that's what he says in real terms. So if you look at educational expenditures in real terms, they're up 180%. So they're probably up 400% if you include inflation in there. So nominal means you don't make that adjustment. Real means you subtract inflation out. So the U.S. government in 2003 introduced a new bond called inflation-linked bonds, or TIPS. I can't remember exactly what the TIPS stands for, but TIPS, Treasury Inflation something. They pay you a real yield, which is a stated yield, and then every year they take whatever principal you invested and they increase it by that year's CPI, Consumer Price Index. So you're essentially getting a real stated yield plus inflation every year. Now, the US is not the first to do these bonds. The UK and Australia have had these bonds much longer, so we do have some history. It was interesting when I went to the conference, it was an inflation conference, and the Treasury was there. When they first introduced these bonds, they really wanted the Treasury to buy these bonds. They wanted the Federal Reserve to buy these bonds just to show that it was a legitimate market. And the Fed governors said, our job is to control inflation, and you want us to buy bonds to hedge against inflation. That looks really bad. We're supposed to protect from inflation. We're buying bonds that are going to benefit. Inflation takes off. It looks like, we don't trust their own job, but that was the goal, is just buy these bonds, get the markets used to them. The first few years they were out there, they were hard to price. They were pretty bizarre animals. They were kind of all over the place. You'd have a year when inflation is surprised on the positive side, and you would think, on the high side, you think these bonds would have done well, but they did poorly. And inflation came in below expectations, and these bonds would do well. It's like, okay, It took a while to figure them out. But they do exist. Let me show you where they are today. If I can find it. So if you just type H15 in Google, the St. Louis Fed comes up. And if you click on their rates, they have historical data. If you want daily 10-year treasury yields back to 1962, you can dump it into Excel. It's pretty amazing. But these are the current rates. So just I don't know what H15 actually stands for. But boy, the computers on our campus are incredibly slow. All right, so here are inflation index bonds. What really jumps out to you about those yields? Anything look surprising to you? They're negative. What is the real yield today on tips? It's negative. Now, I knew the 5-year could go negative. That didn't surprise me when the 5-year went negative, but I thought there's no way the 10-year yield on tips could ever go negative. Who would buy a 10-year tip knowing they're going to underperform inflation? And I was wrong about that. Look at the 10-year tip. It's negative 105 base. If you buy that tip today, you're guaranteed to get inflation minus 1%. Does that sound like a good investment to anybody? You're guaranteed to lose money on a real term, but that's where they are today. It's just amazing. And they went negative several years ago, I think during the 2008 crisis. I can't remember how far, but it's been quite a while since they've been negative. But the 10-year was always, the 5 went negative, like negative 20, negative 30. And we said, yeah, that's just, people are desperate to buy something safe. And so they're putting their money there. When the 10-year went negative, now we even got the 30-year is negative. Who's buying a bond for 30 years to guarantee that they underperform inflation? Pretty amazing. These are shocking numbers. Now I have some YouTubes out there that show you how to use these different bonds to actually see exactly what the bond market thinks inflation will be 5 years from now, 10 years from now. It's pretty amazing. It's called bootstrapping the yield curve. I highly encourage you. I think it's linked in the notes. Do that exercise before you interview for jobs, because it's a really impressive thing. If you know how to bootstrap the yield curve, it's a really impressive thing, and it's powerful. It allows you to get a really good forecast of future interest rates and future inflation from the best forecasters out there, which is the bond market. People who have skin in the game. They've had money invested, and if they're wrong, they lose money. Their forecasts are the best, and you can actually know exactly what they think. So you might do this and you discover that the bond market thinks inflation is going to be 2.4% in 5 years. If you don't agree with that, then you can do some trades to trade against that. If you think inflation is going to be higher, you can do a trade where you can actually win if inflation is higher. If you think inflation will be lower, you can do a trade. You can lock that in. So it's really pretty cool stuff. But anyway, it's just amazing. It's just amazing how low these rates are. Now, if you compare the 10-year treasury, now what is this rate right here? Anybody remember the 128? Is that a real rate or a nominal rate? That's a nominal, right? Because you get 128 no matter what inflation does. What's the real 10-year rate then?
That minus the, excuse me.
Well, it is actually this number. So the real 10-year treasury is negative 105, the nominals 128. So what is the bond market, just in high level, what does it think inflation is going to be the next 10 years?
1, 2, 3.
You just add those two together, 128 plus 105, they think it's going to be about 233. Right, because you should be indifferent between the two bonds. If inflation is exactly 2.33%, then after inflation, you'll get negative 105 here. Here you get negative 105 plus the 233 inflation, you end up with the exact same return. All right, so you should be indifferent between the two. Now, at the inflation conference I went to, this guy named Brian Sack or something. I called him once after the conference. He wasn't real thrilled that I called him, but I called him. But he argues there is an actual inflation risk premium in the 10-year treasury of about 25 basis points. So when people buy 10-year treasuries, they're looking for an extra 25 basis points to cover for inflation risk because they have more risk than the tips people. They're exposed to inflation. So the actual inflation expectation might only be like 210. And then you add an extra 25 to compensate for the inflation risk. So there's some more theories out there. But remember I said earlier in the class, you've got to get a good sense of history. So go out and get these numbers historically and look at where they've been. Where has the 10-year treasury been? You know, last year we hit the all-time record of 0.5%, but what's its average been? What are tips been doing the last several years? These are truly, you know, if I were, you know, let's see, what, probably 12 years ago, if I were sitting at my desk at UTSA and this page came up, I would say, oh man, someone messed up. All the numbers have been distorted. Someone pulled the wrong file in. I would not think this was humanly possible. So we're sitting, just like my friend from Victory Capital, I was like, yeah, those two numbers should not be the same. These numbers shouldn't be negative, but for some reason, there are people out there that want to buy bonds that lock in a loss. And I don't know why that's the case, but that's where we are. Right, so if you want to really mess up a bond person's mind, so here's the question. What is the duration of a tip? If you ask that question, there's a lady at UTSA, Didi. I wish she would come teach here. She is brilliant. She's got a PhD in math. She ran UTSA's income fund, which was their largest mutual fund. Brilliant lady. She called the 2008 crisis so perfectly. I remember sitting in one meeting with her presenting, and I'm thinking, you know, if Didi's right, we really need to move the cash. She's predicting a pretty big disaster. And of course, we didn't listen to her. But I've asked her this question once, and she's just like, there's no way to answer it. So you can actually Google it. And you can see what people are saying. This is the one thing I hate about Zoom, is that thing right there. But just Google it. What is the duration of tips? See, it even comes up. It says an average duration 8.1. What does that even mean? So are you doing the duration in nominal terms or in real terms? We don't calculate duration in real terms. We calculate duration in nominal terms, but tips are real yields. So what interest rate are you asking? Is that their duration in real terms? Well, if inflation takes off and interest rates shoot up because of inflation, the bond price is not going to fall much because you can get the inflation. So how do you actually calculate it? So they say it's 8.1 years, but we don't really understand tips duration. Yeah, absolutely. Most people don't. You could write an entire dissertation on this. So, but people do calculate duration on tips because you can calculate it like any other bond, but the numbers you're going to get can be completely nonsensical. Because if you don't adjust for the fact that tips go up when interest rates go up, when inflation's driving rates up, you're not getting the right duration. But you can calculate it. Yeah, I mean, it's an easy number to calculate theoretically, but just using the numbers, but it's not, the number you get is of very limited value. Oh, wait, sorry, boy. I'm going to be really good at Zoom in about 10 years. There's like two PowerPoints. There's the PowerPoint and there's the PowerPoint and screen shows. So, all right. The nice thing about these tips is they give us insights that we've never had before. So if you go back to the 70s and ask what was the real interest rate in the 70s, you don't really know what that is. Because what is the real rate of interest? The real rate of interest is the nominal rate today minus future expected inflation. In the 70s, we didn't know that. The real rate is not the nominal rate minus historical inflation. It's the nominal rate minus expected future inflation. So in the 70s, all you could do is try to guess what people thought inflation was going to be. You didn't know that. Well, today, we know what the real rate is. We just go get the tip rate. So we actually have the actual real rate of interest. So that's a wonderful thing. We also know what the bond market thinks inflation is going to be, and that is tremendously powerful. The guy who spoke at this inflation conference, the reason I mentioned this one guy at the conference, is that conference was way over my head. Every presentation was like PhD level mathematics. I was like, I have no, you sat there shaking your head like, you shake your head yes when you have no clue what people are saying because you don't want to feel stupid. But this guy, Brian's presentation, the guy from the Treasury came in, and Brian's presentation, and then Milton Friedman was at this conference. So I didn't meet him, but I saw Milton Friedman, kind of my hero. He was up there speaking at the conference. Pretty cool. But this guy's presentation I understood. And he said, I went to dinner the night before his presentation, and it was pretty eye-opening because he worked directly with Alan Greenspan. I didn't realize economists were kind of wild and crazy people. I was getting all these inside stories on the parties they were throwing. But anyway, he said Alan Greenspan's #1 number that he watched was the forward inflation rate from the bond market. That's why you should watch my videos and figure out how to calculate that number and actually build it in Excel and just start watching it every day. And he said, if the bond market has a forward inflation number of 3% or higher, Greenspan was going to be kicking rates up pretty fast. That was dangerous. Once the bond market starts expecting inflation above 3%, that's a problem, and he was going to move quickly. So if that's a very, and I think Jerome Powell and probably his predecessor, Janet, I forget her last name every time, Yellen. I always want to say Janet Reno, but that was under Clinton. So, probably all of them watched that number. Why is that so important? Well, with inflation is a psychological number. When people start thinking about inflation, what do? They start buying stuff faster because they're worried about prices rising. What happens when you buy stuff faster, worried about prices rising? Prices rise. And then what happens? More people start worried about pricing. So inflation is this self-fueling process that can get really out of hand. So the Fed can't wait until people are worried about inflation, because then it's too late. They've got to start acting preemptively. And so they find the TIPS market gives them a really good indication of what, and the bond market is going to react faster than anybody else. What does the bond market think and react to it? So I give you some numbers down here, but if the nominal yield is 4% and the TIP yield is 1.5, then it's sensitive to bond markets. There's a more sophisticated way of calculating it, but essentially the bond market says, hey, we think inflation is going to be 2.5%. This reminds me of a reason why you've got to, when you read articles, you've always got to double check the data, because one of the guys working for me ran USA's gold fund. Well, gold is an inflation protection, right? Inflation takes off, gold's going to do well. And he was reading an article that said that the forward inflation rate was well over 3%. I go, that's not true. And so I went out and calculated. It was still like 220, 210. But they wrote this entire article about how the forward curve is well above 3%, and they just made some math error somewhere. So he just threw the article away, but it's like, no, yeah, I'm pretty sure that's not true. So you always double check these numbers, make sure they're calculated correctly. But if you want to learn this, watch my video. What I would really encourage you to do to get some good practice is go down to the Bloomberg machines and link the 10-year and 5-year nominal, link the 10-year and 5-year tips, and have it calculate the forward curve for you just automatically, that you happen to do anything. You just click the button every time you walk in, it gives you the current number. That would be pretty cool to do. All right, so inflation, we do have bonds now. In my risk management class, there's something at USAA I was talking about. Is it possible to create an inflation-linked corporate bond? And I never got to try this at USAA, but boy, it'd be cool. What I was thinking you could do, and y'all can try this, maybe one of y'all will do this in your career. There aren't inflation-linked corporate bonds. Corporate bonds are all nominal. But what if you bought a corporate bond, you sold the 10-year treasury, and you bought the 10-year tip? What would you have? You buy the corporate, you short the nominal treasury, you buy the tip. Doesn't that sound like an inflation-linked corporate? Wouldn't that give that to you? I mean, do the math. All right, so you can try that. I never got to try that, and I don't know if that would actually work in practice. It's not that difficult to short treasuries. In fact, you don't even have to short the treasuries. You can just do it in the futures market. So it's not a difficult thing to do. It's a very liquid market, very easy to do. I don't know if you'd like the result. I think the biggest issue is how do tips actually react to inflation? How reliable would that be? Because their rates have done some really bizarre things. So I might not get what I was hoping for in doing that. All right. So there it is, five-year forward rate minus some risk premium. So you can teach yourself how to do bootstrapping. I always tell this story because boy, it's so clear in my mind. I was sitting in my office, minding my own business, and I think my 3013 heard this story. But minding my own business, the phone rings, I pick it up. It's USA's CEO. He's in a conference room with a bunch of accountants. He goes, Ron, there's not a single person in this room knows how to bootstrap the yield curve. Can you teach them how to do it? And I just taken the CFA, I had taken the CFA exam, so I knew how to do it. It's like, oh, sure, I can do that. So you never know. There's some pretty basic stuff. If you know it, you'll get a promotion just because you know it. Like, what's the formula for standard deviation? Just knowing that formula can get you a promotion because a lot of people never memorize, never learn these formulas. So that was one. Bootstrapping. Well, yeah, of course. I know. It's not all that impressive because it's a room full of accountants. If it had been a room full of finance majors, that would have been really depressing. But it was a room full of accountants. I can kind of see accountants not knowing how to bootstrap the yield curve. But yeah, there's actual trades you can do. The bond market, you can actually buy. If you want to buy the 5-year treasury 5 years from now, you can do that. Isn't that amazing? You can't buy Apple stock 5 years from now, but you can buy the 5-year treasury. You buy the 10-year treasury, short the 5-year treasury, and you will have the 5-year treasury 5 years from now, locked in. So yeah, it's the bond. It's an amazing thing. It really is what we can do in finance. All right, that's it for bonds. So on a scale of 1 to 1,000, where do you feel like you are on fixed income and bonds? Where were you 2 months ago? All right, where are you today? I'm like a 0.03 myself out of 1,000. So, you know, fixed income is amazingly complex. I met the guy who wrote the chapter in Fabozzi's book on tips. Funny guy. They call him Brenjo, I think they call him. His last name is Brenjoni. Interesting guy. Wrote the book. He could probably talk tips. He could probably come in here and talk about tips, and after about 3 minutes, he could do the whole thing in Mandarin. And if no one here speaks Mandarin, we'd probably understand him just as well if he was speaking. You know, that's how complicated this stuff gets. And that's where you want to be, right? You want to be that person that when you talk, people are like, I have no clue what you're talking about, because you're just such at a level of comprehension. So fixed income market allows you to do that because there's so many things. Tips are so different than corporates, are so different in structured debt, and within structured debt, they're all different, all have their own little strange little quirks. So it's an amazing market. All right, so let's move to stocks. So yeah, I was vice president of equities, which means I was over stocks, and I'm not a big fan of stocks. I can, when Stuart, the guy who I took his place, he was head of equities. He announced his retirement. I was in a staff meeting, and one of the guys working for me, he goes, "Hey, Ron, you should take Stuart's job." And the whole room burst into laughing because they know what I think about stocks. And sure enough, a few weeks later, I had his job. It's not that I'm negative on stocks. I just like bonds a whole lot better. I find them a lot more interesting. All right, so when you do stocks, there's a couple things you got to do. First of all, you've got to set them up. I'm going to give you all a discussion. What is a stock? You've got to make that really clear. Some students lose a lot of points on the exam question because they're just way too high level on stocks. I want you to be very, very clear on what a stock is. And then we got the subcategories, which I use BUCS, B-U-C-S, beta, U.S. non-U.S. capitalization and style. Okay, so we got those 4 things. So what are equities? So bonds, you're loaning someone money. Cash, you're loaning someone money. Stocks, you're not loaning someone money. You're actually becoming an owner of the company. You have an ownership share. So you benefit as an owner, not as a lender. When the firm goes on insolvent, how much do the stockholders get? So GM went insolvent, AIG went under. How much do their stockholders get? better be zero, right? Because the bond, why would the bond, the bondholders can say, well, you know what? We can get 40 cents on the dollar, but the stockholders, I feel sorry for them. Let's take 30 cents on the dollar and we'll give them 10 cents. Do you think the bondholders are saying that? The company goes under the bondholders like, okay, equity guys, you're done for. Get out of here. We're taking whatever's left over. So they're residual owners. They get everything that's left over after you pay off all your vendors and your employees and your bondholders. So it's a residual ownership. But the wonderful thing, and this is pretty amazing. I mean, there's been a lot of debate about this whole concept of limited liability. We take it for granted in the United States. But if you put $1 million in Apple stock and Tom Cook really messes up and Apple goes insolvent, and you have $1 million invested in Apple, what's the most you can lose? $1 million. Is that true for everything? What if you put $1 million in Lloyd's of London and there's a major hurricane and they lost all this money? How much money could you lose? Unlimited. They can call you up and say, you know what? We're losing so much money. You need to give us more money. Say, well, I just gave you $1 million. Yeah, but we're out of money. We need more money. Anyone want to invest in that? Does that sound good? You want to invest in something, you can lose more than 100% of your money, but limited liability is not the case everywhere. And there are actually people today arguing that we do away with limited liability. So if Apple goes under and you're a stockholder of Apple, they can come to you and say, hey, you got to give us some money because we can't pay all our bills. That might have a real negative effect on the stock market, wouldn't it? So we have limited liability. The most you can lose is 100%. You should go out and read some of those articles, the people who are arguing, let's do away. I don't know if I can find them. Sorry, those of you that are on Zoom, I'm not going to switch over because I probably won't be able to find anything. So we'll see. Elizabeth Warren is probably arguing for this. Should we eliminate limited liability? And I don't think that's how you spell we, but wait, between Zoom and has anyone called for the elimination of limited liability? Everything you need to know. So, it's definitely definitely an issue that gets some sway. Some people might be proposing it, but I've seen articles like in professional journals. There's some professors out there that are certainly debating it. It's definitely not mainstream. I seriously doubt Elizabeth Warren has proposed it. But it'd be, that kind of thing. Is business has too much power, we need to get them to have more skin in the game so that they share on the disasters. But limited liability. So the most you can lose is what you invested. So what is a stock return? And to me, it's really, really, really simple. When you buy a stock, you get dividends and you get earnings growth. Can't get any simpler than that. We probably covered this in y'all's 3013 class, didn't we? A little bit. You remember some of this? There is a little bit of overlap. So current dividend yield plus expected earnings growth. There's also repricing, but repricing is PE ratios. Is the market getting more expensive or less expensive? That's completely speculative. So I'm going to leave that part out because it's entirely speculative. If the stock market's overpriced, then you have some negative return to get back to normal. If it's underpriced, you'll get some positive. But it's dividend yield plus expected growth, earnings growth. Now there's one big thing I left out, because historically it's been really unimportant, but firms today are buying their stock back rather than paying dividends. Historically, when firms bought their stock back, the stock issuance minus the stock buybacks, it's skewed toward the stock issuance. They're issuing more stock, they're buying back. The last 10 years, that's actually flipped. Firms are actually not only buying more stock than they're issuing, but that net is actually higher than the dividend yield today. So firms are actually sending more money to their stockholders to buy their stock back than they are through dividend yield. I didn't put that into the numbers. Some people think that adds about 1.5% to 2% to stock return. If you're interested in that, I've got an article that's really, really good article that goes in detail on what stock buybacks go. do for stocks. So it's possible the expected return on stocks, you have to add an extra 1.5 to 2% for stock repurchases. The problem with the stock repurchases is they're pretty concentrated in a few industries, like the big tech companies. So it's not everybody that's doing that, but there are firms like McDonald's that have bought so much of their stock back that their GAAP net worth has gone negative. It's a pretty amazing thing. I don't know why a firm would buy so much of their own stock back that they would make themselves technically insolvent. Obviously, McDonald's isn't insolvent, but they don't have positive net worth. So that's it. That's pretty simple. So if we think about the stock market, let's first test the theory. All right. So, boy. So I've always read that and I've always assumed it was true. And then I thought, well, is it true? So I went back to 1871. Anytime you see 1871, whose name comes to mind? Anybody know? It's one, and I'll give this to you. So no ideas. There's a guy named Robert Schiller. Have y'all heard of him before? Nobel Prize winner. His classes are online. I tried watching his class. I couldn't quite get through it. I like Damodaran and Dr. Lowe, but he's very well known. His classes to me are kind of dry, probably like my classes, so I probably shouldn't say anything. But so it's his classes are, he doesn't bounce off the walls the way Damodaran does. But he has data, and anytime you see 1871, he's the one that got us back there. And you can click on that, and if it ever works, right there, have you heard of the CAPE ratio? You may have heard that on news stations. He's the one that's created that. He went back to 1871, and he has the S&P 500 stock index back to 1871, which is pretty amazing because it was created back in the 50s or 60s. So he's got 100 years of data before the data even existed. I don't know what it was in the stock market in 1871. My guess would be a bunch of banks and maybe railroads or something. I don't know what else. There weren't any tech companies. I don't know if y'all find this amazing. Y'all know the store Cons? Have y'all seen that? Mm-hmm. Doesn't their sign say like electronics since 1879 or something? Y'all seen their sign? I forget what year, but it's like electronics prior to Thomas Edison. I thought, what were they selling? So it's a store that's been around a long, long time. But yeah, I don't know how Schiller went back to the 1870s. Obviously, we had data for stocks, but he had to figure out what was actually in the S&P 500. But what was actually publicly traded back in 1871? What kind of stock market did we have other than banks trading? But he has all this data, and if you go into the data, oh boy, too many things here. He has it on a monthly basis, and the reason I say it's the S&P 500 is these numbers exactly match the S&P 500. He gives you the S&P 500 back to 1871. It gives you dividends back to 1870. I mean, he says the S&P 500 today is like 4,500. He said in 1871 it was $4 or 4. That's where it's 1,000-fold. Dividends, earnings, the CPI. I don't know how you got CPI. You can't get CPI data in the United States back that far. So he somehow figured that out. And then he does this CAPE index. And what he does with the CAPE index is he's doing a price to earnings ratio, which we're going to talk about later, the price of the stock market versus earnings, but then he subtracts out inflation. So he does it on a real basis. So essentially he's doing a PE ratio, but doing today's price over inflation adjusted 10 years of earnings. And he's doing 10 years of earnings, but always inflation adjusted. And so what he's trying to tell you is when the blue line is high, he's saying stocks are expensive. So what can you say about stocks today, according to him? Does this look like a good time to be buying stocks or a bad time to be buying stocks? Really bad time, right? There's only one time in history that stocks are more expensive, and that was in 2000. What did stocks do in 2000? They dropped a bunch, especially tech stocks. So he's saying this is the second most, we just hit for the first time since 2000, we've hit a time that's more expensive than the 1929. Now, what happened after 1929? Great Depression, and so is this the time to be buying stocks? Well, you say, okay, well, I'm not going to buy stocks, I'm going to buy bonds. Well, the red line is bonds. The red line, when it's low, the bond market's expensive. When it's high, bond market's cheap. So how are bonds today? They're incredibly expensive. Everything's expensive. What do you do when everything's expensive? Put all your money in cash. What are you going to get if you put your money in cash? 0.1% return. Is that what you need when inflation's 2%? You can put your money under the mattress. What return does that give you? That's zero. You might sleep better, but it's a 0% return. So it says, I heard someone presenting the other day, well, probably a couple of years ago, actually. It may have been Cliff Asness. I can't remember who it was, but our Jeremy Grantham. So if you look at all the asset classes, no particular asset class, this is back when we're back probably around in here. He said, no asset class looks like a bubble, but we've never been in a point in history where every asset class is at their 90th percentile, where everything is way out there, 10%, only 10% of the time has things been more expensive than this. So everything's expensive, but you've seen it definitely shoot up. Why is the stock market so expensive? But because the bond market's so cheap. The Federal Reserve is keeping rates so low, it's pushing these asset prices really high. So everything's really expensive. We say, well, then I'll buy real estate. How are real estate prices right now? I just bought my mom's house in Austin. I just saw an article that Austin's housing market is the second most overpriced market in the United States. I'm like, okay, Mom, thanks. You got me to buy the house at the top of the market. That's great. Even commercial real estate is pretty expensive. You would think with people working from home and all that wouldn't be all that great, but even commercial real estate. So real estate's pretty expensive. So let's put our money in gold. How's gold doing? It's pretty high. Even with low inflation, gold's pretty high. So where can you go that's cheap? What's a cheap asset to buy today? I heard a podcast on a guy who's putting all his money in Iraq. And he found these small, mid-sized companies in Iraq, and he was doing really, really well. But that was some time ago before they've had some problems. I'm really not sure where you can go that's cheap right now. Puerto Rico debt right now is really cheap. You may want to buy Puerto Rican debt right now. They've also obviously have some fiscal problems, right? They might survive. It's hard to find cheap stuff. I'm buying value stocks, and we're going to talk about that. Value stocks are about as cheap as they've ever been relative to growth stocks. They're not cheap relative to themselves, but there's a problem with buying value stocks right now, which makes me nervous as well. So it's a tough time to invest, but this is a great chart, pretty scary chart. So if you hear the CAPE index, that 38.3 is really a PE ratio, but it's a PE ratio using 10 years of earnings adjusted for inflation. So it's not the same PE ratio you get if you look at the S&P 500. But the nice thing about him adjusting for inflation means that you can compare this over time. We know PE ratios are really high when inflation's low, and PE ratios are really low when inflation's high, but he took inflation out, which means you should be able to compare this all across time. If I did this not adjusted for inflation, you would notice that it's really high today and stocks are really cheap in 1980, but inflation was really high in 1980. When you take inflation out, they're comparable. So it's a scary time to be investing. Questions on that? It's pretty cool. You can get 150 years of data in about 3 seconds just by clicking. And how much did Robert Shiller charge me for that? Absolutely free stuff. Now, we used to update that at UTSA, and he didn't update it as fast as we liked. And so you can get the data from Standard & Poor's. I highly recommend you go to standardandpoors.com. They have some wonderful free data. And I remember calling Standard & Poor's and saying, man, I really need you to update that number. And they're like, well, good luck with that. We'll do it when we feel like it, because I wasn't paying them any money. I didn't have any leverage on it. And they're like, yeah, we'll update it when we feel like it. All right, so I did this chart. I just want to see, is it true that stocks giving dividend yield plus earnings growth? I went back to 1871, and the blue line is the actual total return of the stock markets. So it's stock prices plus dividends. The red line, I took each decade, and I took its dividend yield for that decade and its earnings growth for that decade, and I graphed that. You can see it tracks pretty well, doesn't it? And then in 1929, it got way ahead of itself. So what did it do? Corrected down below, then it did pretty well. The 60s, it got ahead of itself. So what did it do in the 70s? It corrected itself. Then the 2000 crisis happened. What did it do there? It didn't correct all the way down, did it? In the 2008 crisis, right here, for about 12 minutes, Robert Shiller was saying stocks were well valued. That was the only time in probably 2 decades that he said stocks looked okay. And then the next day it was like back to the races. What's happened since then? Well, you can see the huge earnings crush from COVID. You can see the big, I went through 2019 and then I started this in 2020. You can see the huge impact of COVID had on that. So we're way ahead right now, and we've been way ahead for some time. So there's a few things going on here that could be going on. First, stocks could just be grossly overvalued. And this is probably about a 40% overvaluation if you're using my chart. The blue line is well ahead of the red line. But it could be some other things. And one other thing that could make this encouraging, it could be that stocks are far more risky here than they are here. We have a lot more information. Trading costs are much lower. You know, brokerage commissions back in the 70s were like $40 a trade. Now they're free, right? We don't pay anything. I've got a Schwab account. I don't pay for trades anymore. So trading costs have come down. The cost of getting an account, get everything set up, it's much cheaper. So if it used to cost you 1 or 2% just to be in the stock market, and now it's practically free, that gives you an extra 2% return without anything happening. So it's possible stocks are just much more efficient today to own, and they're lower risk. And because of that, we just caught up with all of that. What that means is going forward, the blue line and the red line should be parallel, but the blue line will stay ahead because they had that one-time adjustment for risk and cost. I can buy that argument. The other thing might be those stock buybacks. This higher return might be you need to add that extra. So I actually tried that. If we add extra 1.5 to 2%, it makes a little difference. It's not that radical, but it does help a little bit. So which of those is correct? I don't know, but it is a little nerve-wracking that stocks are way ahead of where they should be versus what you're supposed to get from them. But the thing I like is the red line and blue line do track pretty well until the last 10 years. So my theory is correct until the last 10 years, but it's just fallen apart recently.
And some of that in the 2000s, could it, that correction be from the moral hazards of the Fed helping them out?
Well, the Fed, I don't know if you can say the Fed caused this one. You can certainly say the Fed is pushing this up. You know, interest rates, you go back to 2008, interest rates weren't that low, really. You know, the Fed was saying, wow, we're going to cut rates to 2.5%. You know, that's getting to zero is a pretty kind of post 2008 kind of thing. So, but people were talking about the Fed causing ISIC bubbles. You know, Greenspan had that issue. People complaining about that, but you know, this to me is the .com, you know, the tech bubble, which is way out of line. So this sell-off isn't nearly as bad as it looks because this growth is not as big as it looks, because if you take the tech stocks out, the stock market really didn't get that expensive and really didn't correct all that much. So I think that's a one-time thing. This is the 2008 crisis, which that's more housing and real estate kind of driven, I think, more than the Fed. So I think the Fed here, you got to say, I think you could say the Fed here in the 20s caused that. I don't know, you know, you can go back and look if you want. Your challenge is going to be getting data back that far. You know, I don't know how far back you can get the Fed rate. Probably not past the 60s without too much luck. It's just tough to get data back that far. I don't know. What do y'all think? Should you sell all your stocks? And if you did, what would you do with it? That's the problem, right? Stocks are expensive, so I'm going to sell them. And what? Who knows? I saw a presentation from a professor. It was a podcast, and he said the stock market is grossly overvalued. This market's going to crash 50%. So someone asked him, "What are you doing with your money?" He says, "Oh, I'm 60 stocks, 40 bonds. I'm a long-term investor. I'm just sticking with that." It's like, well, okay, I can delete this presentation. He obviously doesn't believe what he said. That doesn't make any sense. If you think the stock market's going to drop 50%, then do something. Or stop telling people you think the stock market is going to drop 50%. So yeah, it's a very, very tough time. I have all these people asking me, what should I do with my money? It's like, you tell me. This is a very, and I can't remember a time earlier where I had that problem. Most of the time I have a strong opinion. Oh, you should be buying this, you should be buying this. This is a good investment. You should be avoiding that. This is a very strange period of time where it's really hard to find anything that's cheap. So where does expected earnings growth? All right, so we've got stocks or dividend yields plus expected earnings growth. Dividend yield, we can just go look up. That's pretty simple to do. Let me show you how you can look up dividend yield. So you can just go into Yahoo Finance. And let's do the S&P 500. We can't get the S&P 500's dividend yield from the S&P 500 because that is a price-only index. So if you have a price-only index, you don't have a dividend. But is there some security out there that's the S&P 500 that does pay a dividend? But yeah, there's a few of them. I'm going to use the SPY if our computer ever works. Boy, can we be any slower than this? Is that possible? There we go. 3 weeks later. All right. That's going to take forever to load. So there's the dividend yield on the S&P 500, 1.3%. Is that unusually high or unusually low? What do you think from a historical standpoint? What would be your guess? It's pretty, this is pretty low. Historically, it's averaged probably about 4%. That's if you go, 40, 50, 60, 70s, and 80s. Now it's 1.3. There was a theory for the longest time in the 60s and 70s that if the dividend yield in the S&P 500 fell below the 10-year treasury yield, stocks were grossly overvalued. Right now, they're almost identical, but for the longest time, the 10-year treasury yield was higher than the dividend yield for the last 10 years. Now the 10-year treasuries come down, not the dividend yield's going back up. So 1.3 yield, that's pretty low yield. But what's missing from this that I talked about? Well, the stock buybacks. So it's probably not that ridiculously low. You probably need to add another 1.5%, 2% for the stock buybacks, but it is pretty low. So that's where you start with 1.3% plus earnings growth. How fast will earnings grow? All right, so here's my theory on that. My apologies to the 3013 people if you've heard all this before, but it's not bad to hear this again because I think this is really critical for understanding stocks. So earnings growth for corporations should be closely tied to the overall growth of the economy. If our economy grows at 6%, corporate earnings are not going to grow at 9%. It's mathematically impossible. Corporate earnings are traditionally about 14% of our economy. If they grow at 9%, where our economy grows at 6%, then something's got to give up. So what's our economy? Y'all remember the pieces? Boy, I haven't had an equal class in the world. You got corporations, you got consumers, you got the government, got import exports, leaving something out. So corporations grow at 9% where the economy grows at 6%, then what's shrinking? Is it government that's shrinking? Is it consumers that are shrinking? Can consumers shrink and corporations grow? Don't they have to have customers? It's like, wow, corporations make a lot of money, but consumers aren't buying. Okay, well then who is buying? Is our pets are out there buying? There's what are we left with? So corporations can't grow much faster than the economy because economy stays fairly consistent between its different pieces. And historically, I got a chart just to show you that. So what I did here is the red line. I'm sorry, let's start with the green line. The green line is our economy. There's our economic growth. There you see COVID drop. I know they said our economy dropped 30% last year, but they annualized the GDP numbers. So the actual fall was like, I don't know, 7% or something. Still sounds pretty scary that our economy dropped 30%, but you can definitely see it in the number. I mean, you really can't see other drops that dramatic, can you? There's the 2008 drop. So you can see 2020 was a fairly significant event from the long. So our economy on a nominal basis. So why do we have a nominal? Well, because corporate earnings includes inflation as well. When we invest in stocks, we're getting inflation as part of our return because corporate earnings grow with inflation. So the nominal GDP growth is 6.32%. I know that sounds really high, but you're used to the press reporting what GDP number? Real, right? So that's going to be 3-4%. So nominal GDP growth has been 6.32%. This red line is corporate earnings growth. There's 2008. There's 2020. That growth rate is surprisingly slower than our economy, 5.76%. Now, how can that be slower than the economy? Well, this is the S&P 500. It excludes all those new startup companies that are probably growing faster than the S&P 500. So there's a lot of companies not in my red line that are probably going faster. You put them all together, you'll get something probably really similar to the overall economy. So I know most people think, well, if our economy is growing at 6%, corporate earnings are growing 10%, but that's just not mathematically possible. You just can't do that. So the other lines I put on here, I put a 5% in there just to show you that 5 is kind of the bottom for corporate earnings, at least the last several years. That if you want to be conservative, a 5% growth is okay. Now, when you get to paper 4 for this class, you're going to have to make a decision about corporate earnings growth. So I'm going to suggest 5% is probably kind of in that low level, maybe a little lower because inflation's somewhat slower today. And then I put the average 10-year treasury yield, 5.66. Now, why did I do that? Well, because Dr. Damodaran, he argues that over the long term, corporate earnings growth should equal 10-year treasury yields. Now, he said that several years ago. What do you notice about the red and blue line on my chart? They're right on top of each other. So 5%. Now, I know I say 5 and 5.76, but they're right on top of it. So he's, from a long term, that sounds pretty good. What would be your problem with that assumption today? If you assume corporate earnings growth is at 1.3% with US 10-year treasury, you would not be buying any stocks at all. If you think stocks earnings growth is going to be 1.3, there's no reason you'd ever buy a stock in that market. All right. So I think I've got a pretty good case to say whatever your assumption for corporate earnings growth needs to be very much in line with what you think the economy is going to grow. So then the question is, where does economic growth come from? Anybody from my 3013 class remember the components? I think we did this in your class. So here they are. Economic growth. I've got one big one missing. What did I leave out? What was Trump's big thing? What was he going to do? Crush China. How is he going to crush China? What's the one big? Imports, exports, right? I left imports, exports out. But that's not a real big, I mean, it's a big number, but it's not a real big number from what we're looking at here. All right, so the 3 pieces, inflation. You hope you get inflation. Doesn't help you any, you're not any richer, but at least you don't get poorer, so you want inflation. Labor growth and productivity. That's where economic growth comes from. Which of these is the single most important number? Where does the wealth of nations come from? Productivity. If you want to be wealthy, you want to be productive. That's not what our politicians say, except for, I encourage you, the economists, maybe I can find this, and I found it for one student and shared it with him. But President Obama, let's see, he left office, what, 2016, right? Well, I'm losing track of time. So December of his last year, he wrote an article in The Economist talking about his biggest concerns. And guess what his biggest concern was? It was productivity. How will the US get its productivity numbers back up? Because they're pretty pathetic. And it's not just the United States, but it's most of the world. I find that pretty shocking. You would think the internet and artificial intelligence, that our productivity numbers would be at all-time record highs, but they're not. But I'll talk about that, why that may be the case. But if you look back historically, inflation obviously was really high in the 70s, but it's been pretty tame this last decade. Employment growth, labor growth was really high in the 50s, 60s, and 70s, even the 80s, going into the 90s. But the first time in US history, we had fewer workers at the end of the decade than when we started. That's pretty amazing, isn't it? I think it's because in the 90s, banks and construction companies were hiring a lot of people to do mortgages. And then we fired all those people in the 2000s because of the 2008 crisis. Since then, labor growth has been pretty weak. Now, it depends on when I started this, because obviously COVID had a big impact on that. So just, if I did this through the end of 2019, I would have gotten a lot different number than if I did it through the second quarter of 2020. So, your timing can be massive here. But employment growth has been pretty weak. It was strong back here. A lot of it, especially the 70s and 80s, there were a lot of women joining the workforce. You had a lot of military people coming back. A lot more people going to college, a lot more immigration. So there's a lot of things going on that drove those numbers. Labor growth is pretty tough, mainly because China, the US, Europe, we've stopped having babies. So population growth is really slowed down. It's hard to get labor growth without more labor, all right? If people don't have babies, you're not going to have more labor growth. And how's Japan doing on its labor growth? It's a shrinking country, right? People are saying 2050 to be 50% fewer people in Japan than there are today. So that's an issue. Labor growth is an issue because we don't have people having babies. Productivity growth. I have a theory on productivity, but are y'all taking economics this semester? So if not, well, next economics class you take, you can ask someone who knows what they're talking about. Here's my theory on why productivity is so weak. Most of the productivity in the United States was happening in manufacturing. It was car factories and airplane factories. But the US today is only about 15% manufacturing. It's mainly the service industry, and service industries are not good at productivity. If you went into a McDonald's today versus 20 years ago, you probably see about the same number of workers, wouldn't you? It wouldn't be radically different. Now, have you used a kiosk at McDonald's? Farrah, was that your team that did the kiosk? No, you did the pharmacy.
Yeah, we did the HB pharmacy.
Yeah, one of them was talking about kiosk at fast foods, but you did kiosk at a pharmacy. So that was going to increase productivity, reduce labor. Is that going to happen or not? How many of you are ordering your Chick-fil-A on your phone and then going over and picking it up? Are y'all doing that? Is that reducing Chick-fil-A's workers? Can they hire a few people to do that? So, see, what time is it? Boy, you might know what time it is.
3:34.
3, I get 10 minutes. Oh, there's a clock right there. It's 8:10. All right. So, there are two industries in the United States that are woefully unproductive. Anybody want to guess what those two are? You're sitting in one of them.
Here in airlines,
Not airlines. No, airlines actually gotten pretty productive. You're sitting in one of those industries. Education is one of the woefully worst. I just told you we've increased education spending on public education 180% real terms in the last 50 years. And our kids know less today than they did. It's amazing. Y'all have seen the interviews on the street. Whom did we beat in 1776? Oh, we beat the South. It's like, wait, where did you go to school? I don't know where they're finding these people. I encourage you to read. There's a book called The Case Against Education. It's a pretty shocking, scary book. When you actually ask Americans what they know versus what they were taught in school, it's pretty scary what little we know. Education is, now what would make education more productive? More Zoom classes, right? Is it unproductive? You have to drive up here and park, walk to class. Would it be more productive by Zoom? Or are you learning less by Zoom? Who knows? What's the other very unproductive industry? I think I might have heard it. What did I say? Food services, I think, are actually getting more productive. Well, the government's not a, yeah, it's, but education and healthcare are the two. Healthcare is the one I think we might see the biggest change.
Is that because of like telehealth?
Yeah, telehealth, your Apple phones. Yeah. My last doctor's appointment, the lady says, "We're so sorry you have to do this by Zoom. Trust us, next time you'll be in the office." I'm like, I don't want to go to the office. I'm perfectly happy zooming in because your office is 45 minutes away. Yeah, I was just like, why are you apologizing to me? I'd much rather do that. So yeah, we might see Apple's getting big. And that's one thing I love about healthcare. You're seeing Google, Apple, and these big firms getting into healthcare. Seeing Costco, y'all notice Costco's getting into healthcare. What they're doing in our lobbies with these health clinics. So productivity, we're going to have to shift. If you want to get more productive, we're going to have to get more productive with healthcare and education. Those two industries have got to get better because they're a huge part of our economy. Healthcare especially is, you know, almost 20% of our economy, and it's getting less and less productive, not more and more productive. If you take my life insurance class, you'll see why, because we talked quite a bit about that. There's some really bad incentives in education and in healthcare that make them less productive, but that's what we need. So if you're going to want the stock market to do well, you're going to have to get more productivity. And that's the other thing, if you're going to try to figure out where to invest in the world, on the stock market, the best thing you can do is go find the countries with the best productivity, and they're going to have the best stock markets. Why? Because they're going to have the best economic growth and the best earnings growth. So, and which countries? There's a great article written by Robert Arnott. I'll close with this. Great article. I think I can get it to you if you'd like to see a copy of it. But that's his argument, is if you're going to invest in the stock market, you need to focus on productivity. So, and it's not what countries are most productive. He says the key is which country's productivity is changing the most. So who's more productive, a 50-year-old engineer or a 20-year-old college student? Who's more productive? The 50-year-old engineer, right? Because they've got 30 years of experience and know exactly what you're doing. They can go do it. But whose productivity is going to change the most? 20-year-old college students. So what countries are you looking for? Young populations, good educational systems. That's what you're looking for. Where is that? Is it Singapore? Is it China? China's educational system is definitely improving quite dramatically. So that's his argument. It's not the level of productivity, it's the change. And this productivity number is not the level of productivity, it's the change in productivity. And the way the Fed calculates it, it's quite simple. They take real GDP and they take the percentage change in real GDP and they subtract the change in hours worked. So if our GDP goes up 3% and hours worked goes up 4%, what is our productivity? -1%. If our economy grows 3% and labor goes up 2%, we've got 1%. And what has our productivity been historically? It's been 2%. But you can see this last decade, it's only been 1%. How do you get 1% of productivity with the internet and artificial intelligence and all this other stuff? Well, healthcare, education, government, we've got a lot of things that are dragging us down. The US tax code is a good example, very unproductive use of our time. So there are things out there, there are actually some pretty quick fixes that we could do. What is global warming going to do to that productivity? What is shifting in all these, there's a lot of things you as an investor need to take the long picture and figure out, okay, what are these trends going to do? But the nice thing is, as an equity investor, productivity is your single most important number. That's where you need to focus in. If any of y'all want that article, email me and I'll say it's a few years old, but it's a really, really good article. He goes country by country by country, talking about the change in productivity. He shows Japan is the worst. Why? because it's dying. Older people are getting old. It has a big pension plan. He says South America and Central America are great places. Why? Young populations, so that's the key. All right, y'all are making leaving noises, so I'm gonna stop it there. I'll let you out a little bit early.